The invisible market that controls the price of everything. It's not the stock market. It's a secretive, unregulated $700 trillion market that sets the price of your food, your gas, and your mortgage. This is the derivatives market, the invisible engine that controls the price of everything. Most people believe prices are set by supply and demand. This is partially true, but underlying every major commodity price, wheat, oil, copper, interest rates, currencies, is another layer of trading that determines what the real price should be. This layer is the derivatives market. Derivatives are contracts whose value is derived from underlying assets. A farmer's agreement to sell wheat at a fixed price 6 months from now is a derivative. A banker's bet that interest rates will rise is a derivative. These contracts have existed for thousands of years, but they've evolved into something far more complex and consequential than anyone anticipated. The origins of derivatives reach back to ancient Mesopotamia around 5,000 years ago. Farmers faced a fundamental problem: uncertainty. They planted crops, not knowing what the harvest would be, or what prices would prevail when they brought grain to market. To manage this risk, farmers and merchants developed simple contracts. A farmer might agree to sell his wheat harvest to a merchant before planting, locking in a price. The merchant bore the risk of the harvest, but stood to profit if prices rose. The farmer sacrificed potential upside, but gained certainty. These ancient agreements were the first derivatives. For millennia, these contracts remained localized and informal. A farmer in Egypt made deals with a grain merchant in Memphis. There was no standardization, no central marketplace, no way to trade these contracts themselves. This changed dramatically in 19th century Chicago. As American agriculture expanded westward, enormous quantities of grain flowed from farms to the city for storage and shipment east. Farmers arriving with crops faced a problem. Grain prices fluctuated wildly, sometimes changing hour by hour. In 1848, Chicago merchants established the Chicago Board of Trade and introduced a revolutionary innovation: standardized contracts. Instead of each transaction being unique and negotiated individually, the board created standardized agreements specifying exactly how many bushels, what grade, what delivery location, what delivery month. By standardizing, traders could now buy and sell contracts without negotiating each individual deal. A farmer could sell a contract to a merchant, and that merchant could later sell the same contract to a shipper. The contract itself became tradable, creating a marketplace where thousands of transactions could occur daily. This innovation created the futures market. A futures contract is a standardized agreement to deliver a commodity at a specified price on a specified future date. The crucial element was the clearinghouse, an institution that stood between every buyer and seller, guaranteeing performance. If a farmer sold wheat futures and later couldn't deliver, the clearinghouse absorbed the loss. This seemingly small innovation transformed everything. It meant traders no longer had to trust each other. It meant contracts could be traded rapidly. It meant the market could grow without limit. The Chicago futures pits became legendary. Traders gathered in physical pits, shouting and signaling frantically as they bought and sold contracts. The volume was extraordinary. A farmer from Illinois might hedge his risk by selling wheat futures. A baker in New York might lock in his input costs by buying wheat futures. A speculator might buy and sell contracts based purely on predictions about future prices. The price of wheat futures became the price of wheat, not just in Chicago, but globally. If a farmer in Argentina wanted to know what price to expect, he looked at Chicago. The Chicago pit had become the global price discovery mechanism. This is the fundamental insight about futures markets. They set prices. Supply and demand in the physical world certainly matters, but the actual price of wheat is determined by what traders believe about the future supply and demand. A forecast of poor harvests causes wheat prices to rise, even if the harvest hasn't yet occurred. The futures market incorporates all available information about future supply and demand and converts it into a price. But it also means that futures prices can become disconnected from physical reality, especially when speculators dominate trading. The sophistication of derivatives expanded dramatically in the 20th century. In addition to agricultural futures, markets developed for metals, oil, and other commodities. But the real revolution came in financial derivatives. Interest rates could fluctuate just like wheat prices. Banks needed to hedge their exposure to rising rates. So, contracts were created to allow banks to lock in interest rates or bet on their future movements. By the 1980s and 1990s, financial derivatives had exploded in complexity and volume. Interest rate swaps, currency derivatives, and stock options proliferated. The scale of the derivatives market is almost incomprehensible. The notional value of all derivatives contracts outstanding is estimated at approximately $700 trillion, roughly 10 times the global GDP. This enormous leverage amplifies both gains and losses. When the derivatives market is calm, this leverage is invisible. But when the market convulses, the leverage can destroy entire institutions and threaten the financial system itself. This happened in 2008. Banks had structured complex derivatives backed by mortgage mortgages. These mortgage-backed securities were then sliced into tranches and repackaged into more complex derivatives. Rating agencies rated them as safe as U.S. Treasury bonds. Investors around the world bought these derivatives, convinced they were buying safe assets. But the mortgages underlying the securities were toxic. Lenders had abandoned credit standards, issuing mortgages to borrowers with no down payments and no ability to repay. When housing prices stopped rising and borrowers defaulted, the entire structure collapsed. The key moment came when Lehman Brothers collapsed in September 2008. Lehman had written enormous derivatives contracts. When Lehman failed, the entire derivatives counterparty system froze. Financial institutions realized they couldn't trust each other to honor contracts. Banks stopped lending to each other. The credit market seized up. Within days, the global financial system was approaching complete collapse. The derivatives market that was supposed to distribute and manage risk had instead concentrated it in ways that nearly destroyed the entire system. The connection between derivatives and everyday prices is direct. Take oil prices. At any given moment, the market price for crude oil is set primarily in the futures market. The physical oil market certainly matters, but the dominant factor is the speculative activity in futures contracts. When hedge funds decide en masse that oil prices will rise, they buy futures contracts. This drives up the futures price. Over time, the higher futures price pulls the physical price up as well. This mechanism means that derivatives prices can diverge dramatically from the fundamental value of the underlying asset. In 2008, speculators who had bet on higher oil prices suddenly needed to raise cash and sold their positions. Oil futures prices collapsed from over $140 per barrel to below $30 in just a few months. This wasn't because oil supply had collapsed or demand had disappeared. The decline was driven primarily by forced selling in derivatives markets. As prices collapsed, financial losses mounted, creating margin calls that forced more selling in a vicious cycle. Eventually, prices collapsed below the cost of production. The technology underlying modern derivatives markets reveals how far removed the system has become from its agricultural origins. Supercomputers execute millions of derivatives transactions per second. Algorithms make split-second decisions based on tiny price discrepancies, buying and selling in microseconds. These algorithmic traders don't care about the underlying assets. They're pure speculators. The algorithms use mathematical models that assume markets are normally distributed around historical trends. But financial markets aren't normal. Extreme moves occur far more frequently than models predict. The fundamental problem is that derivatives markets have become so large and so complex that they've decoupled from the underlying assets they're supposed to help manage. Agricultural futures were originally designed to help farmers and merchants manage genuine business risk. Modern derivatives serve a different purpose. They're tools for speculation and leverage. The $700 trillion derivatives market is a superstructure of bets built on top of the real economy. When assumptions break down during crises, the system can experience cascading failures that threaten the entire financial system. The price you pay for food, for energy, for your mortgage, all of it is determined not primarily by the real supply and demand of the physical world, but by bets placed in an invisible market that most people don't even know exists. The derivatives superstructure has become so large that it dominates price discovery. The connection between derivatives prices and underlying reality has become increasingly tenuous. As long as markets remain calm and speculative flows remain orderly, the system functions. But when panic occurs and forced liquidations begin, the system can experience cascading failures that threaten the entire financial architecture. The invisible market that controls the price of everything is also the hidden vulnerability that could bring the entire system down.